This is Debt Free in 30, where every week we take 30 minutes and talk to industry experts about debt, money, and personal finance. Here's your host, Doug Hoyes.
Back in May on show number 89, my guest was Hilliard Macbeth, the author of a book called When the Bubble Burst, Surviving the Canadian Real Estate Crash. And in the acknowledgement section of that book, Hilliard acknowledges the contribution of Ben Rabidoux, North Cove advisors who provided valuable assistance throughout. Well, I actually first met Ben last November when we were both on a panel at an investment seminar, and I've wanted to get him on the show since then to talk about his views on real estate. Does he agree with Hilliard that the bubble is going to burst, or does he think that real estate will be a great investment in the future? Well, let's find out. Ben, welcome to the show. How are you doing today?
I'm doing great. Thanks for having me.
Now, did I pronounce your last name correctly? Let's start there.
You know, you're one of the few who did. Usually people kind of butcher that last name, but no, you did great.
We got it good there. Well, I think when we last met, you had to say it to me 4 times for me to get close there. So why don't you give us a quick summary of what it is you do, the company you work for, what exactly are you, what do you do that is related to real estate?
Sure. So I started a company called North Cove Advisors, and basically we're a macro research firm. We work primarily with institutional investors around the world, so mutual fund companies, hedge funds, pensions, etc. I think I get most people recognize me for my work on housing, but that's a relatively small part of what we do overall. We do we have a broad view on the economy at any time. We do a lot of work on household credit trends, rates, currencies, et cetera, and then some equities as well. So we do cover some stock names. So, but I have a keen interest in real estate. It has been kind of a passion of mine for a while, and I'm quite happy to discuss that or any other topic you want to chat about.
Excellent. Well, let's get right into it. And you are based in Ontario, is that correct?
That's correct.
So you understand, what Canada is. Obviously, you're looking at trends around the world, but you're based in here in Ontario. So okay. Well, let's get right into it then. What do you see as the future in Canadian real estate? And I understand that there's no such thing as Canadian real estate. Obviously, Toronto and Vancouver are completely different than, let's say Woodstock is. But in general, where do you see the world going, the Canadian real estate market going over the next, year, 2, 3? Is it going to keep booming? Is it going in the other direction? What's the big picture?
Sure. Well, I guess I should preface that by saying I certainly don't have a crystal ball. I have expressed concern related to housing and consumer debt. It's been several years now and have been spectacularly wrong on that. So, I'm happy to offer a view on it, but like everyone else, it's certainly not a perfect track record. So look, my view is I see a lot of areas for concern, and you're absolutely right. We do not have a Canadian housing market. It's very different by geography, and certainly the Toronto single-family market has very different supply-demand dynamics than, say, Saskatoon. So no doubt about it, you can't make broad statements. That said, we can observe a few things. One is the economy in Canada, and this is really true just about anywhere you look. The economy and the labor market in just about every jurisdiction has been incredibly levered to this current housing boom. And so what I mean by that is if you look at things like construction employment and employment in the FIRE industries, which are finance, insurance, and real estate services, all-time highs in just about every jurisdiction across the country. And they represent a record proportion of GDP in just about every jurisdiction. And so those industries are obviously more than just housing. Clearly not all construction is building houses. Not all finance employment is related to mortgages, et cetera. But what we find when we look back over time is those industries tend to cycle with housing. And when they peak, it generally corresponds with a peak in the housing market. And so two great examples, in the late 70s and late 80s, we had a noticeable peak in construction employment. We had a noticeable peak in what we call residential investment, which is new housing construction and renovation and commissions paid to realtors. Those three things are what we call residential investment. And as a percentage of GDP, they peaked at about 6.5% in the late 70s, which corresponded with a housing boom in BC and Ontario, which subsequently resulted in a very soft market. And then they peaked again, kind of high 6% in the late 80s, which, if you were a homeowner in Ontario in that time, you will remember that after the late 80s, so through the early 90s, was a very soft market for real estate. And so if you fast forward today, we just had the latest quarterly GDP print came out, and we just set a brand new record for residential investment as a percentage of GDP. We're 7.7%. We are way above where we've ever been in any previous peak. And so as an observer of that, to me, it's clear that there's too much of the economy being driven by this, which means that we're moving away from an economy that is producing goods and services to an economy that is too reliant on household borrowing and on building and selling condos to each other. And so that's a concern. And then I guess from the valuation perspective, house prices are very high relative to incomes, but there's also the effect of very low, unprecedented low interest rates. I'm of the view that rates are going to stay low for a long time. That was probably one of the first people to really express the view that the interest rates in Canada were going to go substantially lower before they went higher, and that was back in 2012. And I'm still of that view. So, we could see, this boom could go on for a while longer. Again, I don't have a strong view on when this ultimately ends. But what I can say is, and something that your listeners will want to keep in mind is, real estate is cyclical. And we tend to forget that when we go through these long boom times. And the next cycle, whenever that happens, there's a lot of evidence to suggest that it's going to be worse than some of the previous cycles. And I'm happy to talk about why that is, but that I think is the big difference maybe between myself and Hilliard is I don't have strong conviction on when this boom unwinds. But we certainly share the view that when it unwinds, it's probably going to be quite ugly.
It'll be spectacular. So you hit on quite a number of points there. So let's see if we can kind of break it down. First of all, you said that you've been spectacularly wrong on your outlook over the last few years, and I'm exactly the same way. I mean, you go through the archives and look at what I've said on, various news programs and interviews and so on, and I've said, oh boy, debt's really high and it can't go up forever, and then of course it does, and it does, and it does, and we're at very high levels now. So we're both in the same boat. I think we agree that it's a problem, but what we don't know is when does the problem end. So, and with low interest rates, obviously, I guess you can keep blowing up the balloon more and more. But let's talk a bit about debt then, because after all, this show is called Debt Free in 30. So what role does household debt play in all this? Give me your thoughts on that.
Sure. Look, household debt, I think everyone is quite familiar with the headline figures, 165% of disposable income. It's a concern. It's a real concern. Now, the counterpoint, and one that you'll often hear, is, again, the serviceability of that debt is reasonably benign right now. So in other words, when you look at the percentage of disposable income that families are paying to service that debt, it's high by historic standards, but it's certainly not at all-time peaks. And then on the flip side, people will often say, well, yes, we have a lot of debt, but we also have a lot of assets. I'm far less convinced that that's a really sound argument, because at the end of the day, the asset side of the balance sheet oftentimes is housing itself. And you typically, in a down market, it becomes increasingly difficult to sell the house to settle your debts. So it's not like people can easily say, oh, well, I can just liquidate my assets to settle my debts. That doesn't work in a down market oftentimes. So, look, it's a concern. to me, I think the bigger question is not what's the headline data. And there's a lot of attention always every time we get a new Stats Canada print that comes out about the newest household debt levels. People always kind of freak out a bit about that. To me, it's always what we call the tail distribution that matters. Okay, and so if you think about what is the distribution of household debt, so if we assume that on average it's between 165 and 170% debt to income. So what does that mean? So that means on average people owe $1.70 for every dollar of income they make. That in itself is not that concerning. If you picture someone who had that profile, that's not a debtor that is in a lot of trouble. Okay, so the average is not the problem. The bigger question is, what is the distribution within that average? So what percentage of households have 500% debt to income, 600% debt to income, and how has that changed over time? So the big question is always, how fat is that tail distribution of risky borrowers? And we're getting increasing evidence, particularly out of the Bank of Canada in their latest monetary policy report. Their latest financial stability review. They did some great work looking at that exact question. What is the distribution of debt? How has it changed over time? And they found exactly that the proportion of highly indebted households has risen dramatically since the early 2000s. And so what that suggests is, there's a subsegment of the population that's going to be in real problems if interest rates rise. And I think the other part that people often miss is there's going to be a lot of people that get into trouble if house prices stop rising. Okay, so this is a point I've made oftentimes. We get a lot of pushback from people on this, but I often hear people say, well, if you look at the arrears rate in Canada, it's very low, and so that means that people are managing their money well. I think that's the wrong way to think about it. And so people are often looking at the arrears rate as some sort of a leading indicator for the economy. It's not. And so I'll give you an example of why that is. So if you picture a borrower, let's say a home buyer that just purchased a home 2 years ago in Toronto, okay, and let's say that they lose their job today. In that 2 years, their house has probably risen by 20 to 30% in value. So if they can no longer afford their mortgage, they have options. They can either sell their house, pocket the gain, and look for cheaper cost of living, or they can, as you know, and as you've seen in your practice, they can go out and they can access additional credit secured by that housing equity. Okay, so they can refinance their mortgage, they can take out some money to continue to pay their bills, they can get a second mortgage or a third mortgage, and they can sort of kick the can down the road, and hopefully they find employment and house prices keep rising and it's not an issue. Okay, but if you instead look at a situation where house prices stop rising, or God forbid they fall, that same borrower, when they run into problems, they don't have options. And so that's when you see the arrears rate start to really rise. And we saw this in the U.S. as well. If you look back at 2005, 2006, that's when house prices started to flatline across the country in the U.S. And it really wasn't until a year later, when some of those riskiest borrowers could no longer refinance, when all of those exotic mortgages, like those adjustable rate mortgages, when they reset and those borrowers were not able to refinance into conventional financing, that's when you saw the arrears rate really spike. And so my view has always been that the arrears rate is a lagging indicator, and it's going to be a function of house prices. And so that's why, I've got this view that if house prices just flatline in Ontario, and if they go flat for a year or two, it doesn't happen right away, but if they go flat for a year or two, but the economy doesn't deteriorate, if all that happens is house prices just go flat, you'd probably see a doubling in the arrears rate, right? Because we're artificially low right now. If you look at it in Ontario, and I have to look at the exact numbers, but we're something like 15 basis points in arrears. So it's 0.15% of the population is in arrears in their mortgage. That is unbelievably low by historical standards.
Yeah, it's essentially nobody.
The economy is not, insane. Yeah, nobody. Nobody. And so that goes to my point. If how can you default on a mortgage in this market when the prices are rising so quickly? You have so many options at your disposal. That changes dramatically when you see softness in the real estate market.
And so, is there anything that you can see that would cause prices to stop rising? I mean, obviously, mathematically, house prices cannot go up forever. It means a one-bedroom condo in Toronto will eventually be worth $100 million. I mean, in the absence of hyperinflation, that just doesn't make any sense. But is there anything else that could potentially cause a leveling off of house prices? Is it really just a general economy, or could it be something else?
Well, there's a number of factors that I think are at work in the housing market. I think there is. I mean, look, it's a topic of some contention right now. But in my view, having done extensive due diligence on the front lines, is there is a sizable foreign bid in both Toronto and Vancouver, particularly Vancouver, but also in Toronto. And we don't really understand the mechanics or the dynamics behind that, but it seems that there is definitely some element of that bid that is somewhat of a capital preservation bid out of China in particular.
So you're talking about Chinese investors or people from outside of Canada buying real estate in Canada, perhaps because they need to get the money out of China, and that is helping support the real estate prices. Do you have any sense of how significant that is in a place like Toronto, for example, or is it impossible to know for sure?
Well, it's impossible to know for sure. We don't have hard data on this. The government is looking to collect hard data, so CMHC in particular is trying to figure out how to better track this. I mean, my sense is this, and again, this is nothing more than just trying to triangulate anecdotes. So this is not scientific in any way. And there's a saying that the plural of anecdote is not data. So this is not hard data by any means. But my best guesstimate is we probably are seeing somewhere between 5 to 10% of resale transactions in Toronto are foreign bid. And that's obviously much higher in certain property segments and certain locations. But I think across all of Toronto, it's probably something like 5 to 10%. I'd be surprised if it's significantly higher than that. I think in Vancouver, it could be 15 to 20%. Again, this is just complete throw in a dart. My best guess, having spoken to extensive people on the front lines. But I think that what you have to keep in mind is, so that's the percentage of resale transactions. But when you look at the property types that are often being purchased, they tend to be much higher price points. Particularly in Vancouver, they tend to be kind of the ultra luxury, West Side Vancouver, single family, et cetera. And so if you look at it instead as a percentage of the dollar volume of sales, I mean, it could be 3 times that. So you could be talking 15 to 30% of the resale dollar volume in Toronto is foreign. That's a huge number. And that has all sorts of trickle-down effects. So the family that bought a home, a detached house, central Toronto, 40 years ago for some obscenely low price by today's standards, is an instant millionaire. And so they then often, as the anecdotes go, they would sell their house, they would gift some money to all of their adult children, who then in turn use that money to jump into the real estate market, and mom and pop sort of downsize and move out of central Toronto. And so you can see how that trickle-down effect has an impact on the rest of the market. So look, that's a real dynamic. There's some question around the sustainability of that dynamic in its entirety. I think there's always going to be a foreign bid. Canada is certainly an attractive place, but I think the magnitude of the current bid is probably unsustainable. But that said, I don't know exactly when that changes, and we could see tomorrow that Beijing tightens capital controls and the bid drops by 50% overnight. It could happen, right? So we don't know, but my feeling is that this is not a permanent sustainable bid in its current size, that there's a sub-component of this that is speculative. It is a hot money bid. And one thing you can be certain is that hot money that flows into an asset class will always flow back out, always at some point. And so, again, not the entirety, right? There's some of this foreign bid that's a legitimate, we want to live here, we want to send our kids here. It's a sticky bid, but there's a speculative bid as well, and that's somewhat more of a concern. So that's one dynamic that, when you think about what could tip the market. And then certainly the broader economy, if we saw a broad slowdown, I think the most likely area where we would see a broad slowdown, at least in Ontario, would be more in the construction industry. I'm still of the view that when you look at underlying demographics, it's difficult to make an argument that we're building at a sustainable level. And so if housing starts to fall significantly and the level of construction and housing renovation were to fall, then you've got a big hit to the economy and the labor market. That's one area. You could get some sort of exogenous shock. The U.S. goes into a recession or who knows what. And then I think the third obvious one is interest rates. I've said that I don't really think that's going to be the trigger, but look, if the Bank of Canada moved, or if, perhaps more importantly, if the Federal Reserve in the U.S. were to hike another 25 or 50 basis points, that affects our bond market. And our 5-year fixed mortgages tend to be priced off of the 5-year bond yield. And so even if the Bank of Canada doesn't move, we could find that fixed mortgage rates in Canada start to creep up. And there's not really a lot of wiggle room on affordability there. So it could certainly pinch affordability and cause some sort of a reduction in demand.
So there's lots of potential factors. Well, that's very good. We're going to take a quick break, and then we'll come back with a bit more with Ben Rabidoux. You're listening to Debt Free in 30.
You're listening to Debt Free in 30. Here's your host, Doug Hoyes.
Welcome back. It's time for the 30-second recap of what we discussed today. My guest today was Ben Rabidoux, who described some areas of concern in the Canadian real estate market. He said that real estate is cyclical, and just as prices corrected back in the late 1980s and early 1990s, it could happen again. That's the 30-second recap of what we discussed today. I agree with Ben's point about FOMO, the fear of missing out. Many people today see that interest rates are low, and since it seems that real estate keeps going up in value forever, they want to get in now because they don't want to miss out on future gains. Well, it's mathematically impossible for prices to go up forever, so be very careful not to borrow more on a mortgage than you can pay back. It's no fun being house rich but not having any cash left over to live your life. Ask yourself the question, if I was to lose my job or if my income was to go down, could I still pay the mortgage, the property taxes, the repairs and maintenance, and my condo fees? If the answer is no, you're probably stretched too thin. And as Ben said, for many people, now is a great time to rent. That's our show for today. For full show notes, please visit hoyes.com. That's HOYES.com. Thanks for listening. Until next week, I'm Doug Hoyes. That was Debt Free in 30.